Hello, I'm Gavin Preston, Managing Director of Behind the Counter, Private Equity Deal Maker, CFO, Angel Investor. In 20 years and $1.2 billion worth of transactions, I believe that corporate finance and private markets are not as complex as people make them out to be. I'm making videos like this one to bring global private equity venture capital expertise to everyday business owners. This video is the third in a series of 3, answering the question that comes up for selling business owners: what do I do if I only have low offers? The first is try to negotiate an earnout. Second is on vendor financing. And the third is this one, walking away. Walking away, or alternatively, and maybe a different way of putting it, is saying rejecting the offers and then hoping that or believing that something's going to happen where maybe another buyer will offer more than what they've offered, or alternatively, you're going to walk away, strategically change the business and come back and get a higher offer later. Now, there's an example that I'd like to go through that is very relevant to this, where I learned a lot from a seller and how they acted and what they did. And it resulted in them walking away, actually rejecting a bid, and then coming back and getting a significantly better outcome for the seller. In this instance, I was with the buying group. I was with on a side that wanted to do an acquisition. We looked through the market. We targeted a particular company without a whole lot of financial information or really knowledge about it. We set up a meeting with the CEO to discuss potentially buying their company. And the decision was made that we would we would offer a very low offer. We had a very low price for the business. It was pretty much a low ball offer. Now, it's kind of a bit of a digression, but it is very relevant to this particular discussion. Sometimes we like to watch, it's called Succession. We watch, Wall Street. We read some books. We maybe read Art of War. We might have some experiences where we've done something amazing one way or another. And we decide that the best way to go about into negotiations is to, really lowball something. And then, if they negotiate you up, then they'll negotiate up just a little bit and you still get this amazing deal, right? My personal feeling is that you can get a little bit carried away with yourself and maybe have a little bit of hubris when you do this. The reality is I feel that most part buyers and sellers are actually pretty smart people, and they're not just going to give away things for steal as a deal. And so in this particular instance, I would have preferred that we went down a route where, and there's certainly buyers out there that do this. Most buyers actually really go, and the ones that are out there, they will provide term sheets. And when they provide written term sheets, it's a genuine expression of where they are at. They're knowledgeable, they're confident about the industry, they know more or less where something is valued. And when they provide an offer, it's a real offer. Like it's absolutely 100% genuine. So they won't probably move much from that offer, but at the same time, it's quick, it's easy, you know where they're at. And if there's no deal there, then you just move on. So in this instance, there's arguments either way. You can go either way, and that's fine. In this instance, even though I prefer the latter, we did the former. We gave this really low offer, sat down with the CEO. It was a bit of a shocking offer. I think he got a bit flustered. But what I learned from him was exactly how to act and what to do in this sort of circumstance. So this CEO, he kind of didn't tell us where to go. He didn't tell us right out, no, that's no good. He didn't shut the door in any way. He walked away from there. We sent a written offer the next week, and it had a very similar value in it than what we offered him verbally. About 2 or 3 weeks later, we got a letter back, so we didn't really hear back right away. And the letter said, look, we really think there's a deal here. We love you strategically. We think there's lots of good reasons to do a deal. But frankly, and with all due respect, we don't agree with your valuation of the company. And what we would do is we'd invite you to, have a better look at us, respond, give us some questions, allow us to respond back to you and show you the value of our business. And then we can go into, maybe we can come to a deal after that. So we did just that. We did what we call commercial diligence. We looked into the business. We tried to figure out all of the elements of it that were, what was driving the business, why was customers coming to it, where were revenues coming from, where were profits coming from. And we got to deepen the relationship. We spent some time with the people. We started to get to know them more and more. And as we did that, when it came to the final negotiation and we came to an actual deal, if you bring in all of the transaction costs and all of everything that was going to be paid out by the buyer, amounted to 50% higher than what was the original offer. So it was a great outcome for them. Now, this was a strategy, this was a circumstance where this strategy of rejecting the offer, potentially walking away, worked. But it's important to know that there was specific extraordinary circumstances that occurred around that. So one, it was a buyer-led sort of bid, right? They didn't go through a process. They only had one offer. there was the potential that there might be another person out there who would actually provide a better offer. So if this didn't work out, they could always, count on the fact that somebody probably would value their business more highly than we were at the time. And the second component was that, they weren't in a rush to sell, right? They weren't really motivated in some sense. They were, but not so much, like they weren't a retiring owner operator or something like that where there was a need to really sell. So what this means though is that I want to come back before you reject an offer, you do almost exactly what the seller did, right? You go, okay, that's very nice, thank you, and you move back. And you need to strategically think about what you're doing. When we're talking about getting the highest price possible in a sale, we talk about preparing your company a year before, maybe you go to sale, things like getting a good narrative, getting good process, getting in front of the right buyers, targeting them, all those sorts of things. It's basically like you're taking steps and going up a staircase. So every time you take another step, you get a bit higher, right? The price gets a bit higher. But whether or not the staircase is 5 or 50 steps is actually really truthfully up to a market. The market itself, it's just like anything. The value of whatever it is you have is only worth what somebody's willing to buy for. So if you go through a very extensive process, get multiple offers, the reality is that that's probably where your business is worth, right? Even if you think it's really, really low. So when you're asking or you're going to walk away, before you do so, you have to ask yourself, is there just something I'm going to do? Like I'm going to ask somebody to pay more and they're just going to pay more. That seems probably unlikely. The other side is you're going to walk away from the sale. And what you're going to want to do is be able to provide a narrative in the future. You're going to provide a situation in the future where you walk away from the sale, you grow the business. Fundamentally, that improves the value of the business. You go back to those same buyers. You say, now that we've shown you the value is higher, will you reconsider your offer? That strategy can work, but there's always the risk. And the risk is that you spend the next 2 or 3 years, maybe or 1 or 2 years, and the business doesn't grow. Now, in that instance, you'd go back to those same buyers and say, will you buy my business? They might sort of sniff out that maybe you're a bit desperate. And if that's the case, they might lower their offers, not actually increase them. So that's the risk you have in selling your business in walking away. So before you do it, you need to be very, very honest about yourself. If you walk away, can you genuinely grow the business and come back and get more for it later? You might be in a niche, and if you were in a niche part of the market and you pretty much saturated that niche and now you're looking to do a trade sale, it could take a long time for you to be able to, expand and grow and get bigger in the market. Companies, they tend not to really grow in nice linear fashions that usually, especially as you lead up towards a sale, you kind of plateau a bit. And to grow, you might require more increased capacity. You might need more, senior level staff around. You might need more people just in general. All of these things, they cost money. They drop your profits in the short term, and they take time to pay off. You might not have that time. You might not actually want to go through that process. And if that's the case, then this isn't really a good strategy for you. You need to actually maybe consider taking, even if you think they're low offers, take them because the strategy of walking away carries too much risk that actually you get lower offers later. The only other way that this might work, and this is a bit of a comment, if the markets, for some reason, conditions in the macroeconomy, let's say, change, and for some reason or another in the future, the same people you have already taken the deal to will pay more or higher multiples, if you will, than they do right now. And then you might be able to, that might be a strategy as well. Now, in private equity management, we call that luck. And I would say that if you're strategically looking at something, hoping that market conditions just get better, hope is not a strategy. So it's probably not a good idea to just hope that the market somehow later pays you more. That being said, there is extraordinary circumstances where that might come into play. So if there's a major sort of event or something that's suddenly taking and messing up the markets a whole lot, so like the global financial crisis or a pandemic or something like that, yeah, you suspend, walk away, come back. You would be reasonably expected that you'd get a better price in a more normal kind of market environment than those kinds of extraordinary events. Anyways, just bringing this all in summary, I mean, really, if you get a low offer, what are you going to do? You're pretty much going to try to negotiate some kind of deferred payment structure like an earnout or vendor financing. In this instance, you can reject the offers. You don't do it necessarily right away because you need to understand, You need to ask yourself, can you grow the business or fundamentally change? Did you run a process that you're confident that generally you've got a pretty good price? And the reality is this is what the market is telling you your business is worth. And if the case is that, you being honest with yourself and you actually say, I don't think I can grow this, then the only thing that's really left to do is really accept one of those lower offers and mitigate the risk and get a deal done.